Sweet Jesus, Mary, and Joseph. We have an earnings marathon today. I'm going to collapse in exhaustion when I am done live streaming today. Welcome back to Strongman Personal Finance. We're going to cover the earnings of McDonald's, Disney, Uber, Shopify, and DoorDash just in this one live stream, and we have 2 more scheduled. We'll see if I make it. So let's dive right into the earnings. So the first stock on the list, let's make sure we're sharing because I'm always paranoid about that, is McLards. So McLards is obviously a fantastic company when it comes to legacy, staying power, corporate profits, but it also makes you extremely fat. Go ask Fat Money about that one. So McDonald's reported today, and they're up 3% on the day and down slightly in the after hours. Nothing crazy, no wild swings. Let's see what McDonald's reported. Global comparable sales increased 3.8%, so slightly more than inflation. System-wide sales to loyal customers across 60 loyalty brands were $33 billion for the trailing 12-month period, and approximately $9 billion for the quarter. Now, I actually don't have any loyalty points with McDonald's. I refuse to download a loyalty app for McLards. I have a Chipotle app. That's it. McDonald's is for lard buckets, and I'll leave that at that. Okay, so let's break out the sales. Let's disaggregate it a little bit. U.S. sales increased 2.5%, so with inflation. International increased 4%. And international developmental license markets increased 5.6%. So overseas has been growing revenue a little bit faster. Consolidated net revenues increased 5%, and system-wide sales increased 8%. Consolidated operating income increased 11%, or 8% in constant currencies. So they actually got a little boost in operating income from currency fluctuations because the dollar has actually been weakening. At least there's the trend of it weakening over the past couple of months. But that's pretty healthy growth in operating income, okay? It's pretty good. 11% for McDonald's. This is not a small company. Results included pre-tax charges of $43 million related to restructuring charges. Excluding those current year charges, as well as prior year pre-tax charges, consolidated operating income increased 7%. Okay, a little bit less if you exclude some one-off stuff, but that's still not bad growth. Okay, that's better than a bond. You know, bond interest doesn't grow if you buy a bond and hold it. Diluted EPS was $3.14, an increase of 12 cents. And if you exclude all the other crap, it also grew 7%. So it's okay growth. So we know that revenue was growing overseas faster than the United States. Basically, the U.S. is keeping up with inflation. That's literally the most recent inflation reading was 2.5%. All right. Let's see. Key metrics. So we already covered all this. I like how they describe it in detail here, and then they literally just repeat the information here. So we know that profits grew faster than revenues. And part of that was because of currency fluctuations and because international is growing revenue faster. Okay. Not bad, McLards. Nothing catastrophic here. All right. So they break out revenue by franchise restaurants and company-owned and operated restaurants. So company restaurants didn't grow revenues at all. Franchise restaurants, this is where they make all their money, grew by 7%, okay? So obviously the franchising is over 60% of their revenue, and it's still growing pretty healthily, and I imagine they make pretty high margins on that. Look at this. Look at these margins. Franchised restaurants occupancy expenses, $654 million. That's a pretty high margin. Their margins suck on company-owned. They're garbage. So their only revenue grower, their primary revenue grower, there's just other revenues here, whatever that is, but their primary revenue grower also has the highest margins. I mean, they're company-owned restaurants. What is their margin just based off this? 15.4%, and then their franchise restaurants, at least based on what they specifically state, has an 84% margin. But if you include other expenses, maybe not so high. But obviously the franchise has a higher margin because you're not operating a freaking store. Okay, let's see. No real explosion in expenses. I don't see anything crazy on here. Interest expenses up slightly. Pretty solid earnings overall. Okay. This is 6 months, so whatever. Okay, so very, very short earnings report, but I mean, pretty solid. They're growing profits. They're growing revenues. It's a little tepid in the United States, but they're definitely growing those franchise revenues pretty good, and that's their highest margin business. So not bad earnings for McDonald's. What's their valuation, bruh? Actually, how's the stock done? Yep, it's just a slow, choppy increase to the right with a dividend yield of 2.3%. I mean, I don't think this has beaten the S&P 500. I don't even think this has beaten VT, which is hilarious. But, I mean, I don't think McDonald's is going anywhere, okay? Valuation-wise, let's see how expensive they are versus the past. So, PE's right around normal range. Forward PE's right around normal range. Price to say, everything seems to be about the normal range here. Nothing freaking crazy. What's the price to, am I blind? Oh, I guess they haven't updated it yet. But, yeah, I don't have anything bad to say about McSharts, okay, besides it gets you fat. Now let's move on to Disney. Let's see Disney. Disney. Hey, guys, I'm Mickey Mouse. So Disney sold off a little bit today at negative 2.66%, and it's up 0.08% in the aftermarket. Oh, Lordy, how exciting. Let's see what happened with Disney. Financial results for the quarter. Revenues increased 2%. 2% revenue growth. Income before income taxes increased 4%. All right, so basically you grew your profits slightly above the rate of inflation. Okay. Total segment operating income increased 8%, and diluted earnings per share improved to $2.92 from $1.43. So I'm sure there was a big one-off item here that affected the earnings per share last year because that's some astronomical growth in diluted earnings per share. All right, key points. Entertainment. Segment operating income of $1 billion or $179 million decrease versus last year. Direct-to-consumer revenue increased 6%, which included an adverse impact of 3 percentage points due to Disney Plus Hotstar being included in the prior year's operating results. Okay. That's okay growth. Direct-to-consumer operating income barely grew. It grew to $365 million from $300 to $46 million. So that is an increase of 5.5%. It's okay. 183 million Disney Plus and Hulu subscriptions. Hulu is garbage. Hulu is so bad. I don't know who watches Hulu. And I can't. So I have a 2017 TV downstairs and it won't download Disney Plus. Like it's something about it. So I don't have Disney Plus myself personally. Disney Plus increased subscribers by 1.8 million. So they're growing subscribers a little bit. It's not like insane freaking growth. It's definitely slowed down. Linear Networks operating income declined $269 million, largely driven by the Star Media India transaction. Content sales, licensing, and other declined by $275 million, reflecting the performance of titles in the quarter compared to the strong performance of Inside Out. I've never heard of that in my life. Sounds like a corno, if you know what I mean. Clap me inside out. Sports ball. Operating income of $1 billion, an increase of $235 million. That is pretty strong growth in sports profits. Year-over-year, well, okay, here's why. Year-over-year increase reflects the impact of $314 million loss on Star India. Never heard of that in my life. I don't watch any sports. Domestic ESPN, which I never watch. I hate sports. I hate watching sports. Operating income declined 7% because of female basketball. Primarily due to higher programming and production costs, reflecting contractual rate increases for the NBA. I bet you the WNBA had an impact on that one. Domestic advertising growth of 3%. That's freaking weak. Experiences. It's the Disney parks. Segment operating income of $2.5 billion, an increase of $294 million. Okay. The operating income reflects a $40 million benefit from the timing of the Easter holiday and a $30 million impact from pre-opening expenses at Disney Cruise Line. I am taking my kids to Disney one time. One time. I'm not going to be one of those fanatic weirdo Disney freaking, oh, we got to go every year. Oh, why don't we go to travel the world? Let's go see New York. Let's go travel to the Shenandoahs. There's lots of things to see in America instead of wearing stupid Mickey Mouse ears. All right. Forgive my rant. Guidance and outlook. Q4 2025. Total Disney Plus and Hulu subscriptions increase of more than 10 million quarter over quarter, with the majority increase coming from Hulu as a result of the expanded charter deal. Okay, I'm not bullish on Hulu. Hulu is poop. Disney Plus subscribers, modest increase in Disney Plus subscribers compared to Q3. They don't even specify what the modest increase in Disney Plus. Disney Plus's growth is kind of slowing. All right, so, okay. What does the CEO said? Bob Iger. The company is making major steps forward in streaming with the upcoming launch of ESPN's direct-to-consumer service. Not doing that. Our just announced plans with the NFL and our forthcoming integration of Hulu into Disney Plus. Not bullish on that either. Okay. We have more expansions underway around the world in our parks and experiences than at any other time in history. We're not done building Disney. So they have some nice, convenient breakdowns here. So revenue grew 2%. Operating profits basically grew 4%. Diluted EPS, massive growth, but that's probably a one-time adjustment thing. Diluted EPS, excluding certain items, 16% growth. I mean, that's okay. Cash provided by operations, steady free growth. That's pretty good growth. Cash provided by operations increased by 41%, and free cash flow increased by 53%. So very strong cash flow growth, but very weak revenue and okay profit growth on the accrual basis of accounting. Their fastest revenue grower is experiences, going to the stupid parks. Everything else sucks, especially sports. Segment operating income. So sports revenues dropped 5%, but the profits increased 29%. Experiences grew profits pretty steadily at 13%, so faster than revenue growth. And that doesn't surprise me because all those Disney fanatic morons will pay anything. They'll pay anything to go to those parks. One time. Okay. They're expanding into India. Are you bullish on India, bro? Entertainment. Linear networks, revenue down 15%. Direct-to-consumer, Disney Plus, basically up 6%. Oh, God. What a freaking disaster. Okay. Look at who the hell is texting me? Oh, sorry. Oh, somebody whining. Of course. Cheeks. Let's see. All right. I mean, okay earnings, nothing crazy. I thought Disney Plus was growing faster. Paid subscribers at Disney Plus, flat quarter over quarter. International 2% growth. Yeah, Disney Plus is not really growing that well. Hulu grew by 2%, the number of subscribers. Very weak growth there. Average monthly revenue per paid subscriber, barely up for Disney Plus, and international up 2%. Yeah. I had such high hopes for Disney Plus. Experiences. God. Yeah. Not super impressive, to be perfectly honest. Let's see. Wow, look at this. They are making some huge investments. Investments in parks, resorts, and other property. So last year, they invested $3.9 billion in parks, etc. This year, for the 9 months ended June 28th, 2025, they invested $6.1 billion. So they're making some huge investments in parks, resorts, and other property. Okay. So why did cash from operations experience Deferral of tax payments. Okay, so basically a timing issue with tax payments seems to be the main thing. Capital expenditures. Yeah, they're dumping huge capital expenditures into domestic experiences. So like all the parks and stuff. $4 billion in the last 9 months. International slight growth in capital expenditures at $865 million. Wow, they're really dumping money. Depreciation, who cares? All right, well, that's it. Kind of tepid earnings. I mean, maybe the investments will pay off at some point, but Disney Plus not doing good recently. All right, so that's Disney. Obviously, the stock didn't go crazy either way. I'm not surprised. Let's look at Goober. So Goober is flat. Flat like your mom. Let's read Goober. All right. And Uber does have kind of a moat. Now, I hear Tesla's going to take them over. Oh, my God, the robotaxi is going to take over. The robotaxi is not going to take over Uber. Who is calling me? Oh, my parents. Oops. Wait till after the video. I've got very important stuff going on here. Okay. But like I was saying, Uber is like very dominant. Their only main competitor is Lyft. And I found myself using Uber a lot when I need to. It's a good company. Okay. So anyway, trips during the quarter grew 18% year over year. That's very solid growth. Gross bookings grew 17%. Revenue grew 18%. Income from operations grew 82% to $1.5 billion. That's very impressive growth. Net income was $1.4 billion. Adjusted EBITDA, blah, 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 blah. Net cash provided by operating activities was $2.6 billion. Very solid. Let's compare this to I wonder if they updated this already. Man, they are on freaking point on freaking stockanalysis.com, and it's completely free. Look at that. God, look at that operating cash flow growth. They've really impressed me. For a while, they were struggling. They were not doing very well. Back during the clown market, now they've actually really turned around. They're doing fantastic. And I think they personally have a moat. I mean, they're only, like I said, their only competitors Lyft. Robotaxis, excuse me. How much is their free cash flow per share grown? Yeah. I mean, Uber's been doing pretty good. Very impressive growth in revenue. Very impressive growth in operating cash flow. Free cash flow. Nothing bad that I can really see. For Q3 2025, we anticipate gross bookings of $48 billion to $49 billion, almost $50 billion, representing growth of 17% to 21% year over year. Our outlook assumes a neutral to modest positive FX foreign exchange of impact. And as a reminder, our outlook includes the contribution from the close of the Trendyol Go acquisition. Excluding this, our growth outlook will be 16 to 20%. Still good. Yeah. I mean, Uber's been executing. Let's see. Gross bookings, mobility. This is travel. Delivery. Who uses delivery? It's so expensive. Grift. I almost never get food delivered. The only time I get food delivered is somebody gives me a freaking gift card. Anyway, delivery bookings are up 20%. Mobility's up 16%. Freight is down 1%. That's a very small portion of their revenue, though. All right. Revenue. Yeah. Delivery's killing it. I'm not surprised because they freaking charge a fortune. Adjusted EBITDA for delivery. Yeah, delivery's been cooking, man. Delivery's been cooking. All right, so pretty impressed. Very impressed, actually. Uber's doing well. Doing very well. They were not doing well a couple of years ago. I remember that. Let's see. Is there any growth in expenses that are worrying? No. Nothing crazy. Looking pretty good. Looks like modest share buybacks, maybe. Let's go look at the statement of cash flows. What are they doing with their cash? They spent $325 million. Oh, is this 2024? Yeah. You see how the companies, they'll change. Like some companies will have 2025 here, and some companies will have 2024 here. So in 2025, for the first for the last 3 months before this report, they bought back $1.3 billion of stock. Okay. No dividend. Oh, it's a worthless company. I guess we can't invest in it now. And using Uber myself, I've been very impressed. They even have a feature. I was flying out to go on a trip. They have this feature where you put in the time your flight is supposed to leave, and it literally back plans for you and tells you exactly what time you need to get picked up for when you schedule. It's pretty cool. And it's planned to get you at the airport exactly 2 hours before your flight takes off. I was like, wow, that's pretty cool. All right, so not bad for Uber, not bad. I guess the market right in line with the market's expectations because I don't see any vertical lines. All right, Shopify. What happened to Shopify? Up 21%. Okay, Jeremy. How's the stock done recently? Good Lord. Good God. Look at it. Cooking. Canada stocks, bro. Shopify announced today financial results. Shopify achieved 31% revenue growth and 16% free cash flow margin. Pretty good. Let's see. So gross merchant volume is up almost 33%. MRR, forgot what that meant. Up a little bit. Revenue is up about, like they said, 31%. Gross profits up about 30%. Operating income's up about, drawing a brain fart here, 20-something percent. Okay, pretty good growth. 2025 outlook. For the third quarter, we expect revenue to grow at a mid to high 20s percentage rate year on year. Gross profit dollars to grow at a low 20s percentage rate. Operating expenses, a percentage of revenue to be 38 to 39%. And stock-based compensation. And then free cash flow margin to be in the mid to high teens. So they're doing pretty well as well. Okay. Subscriptions revenues grew by about roughly 20%. Merchant solutions grew revenues by 36.5%. Man, yeah, they make a lot of profit off of that subscription solutions. So they generated $656 million of revenue and only spent $121 million on directly attributable costs. So that's definitely their higher margin segment. Sales and marketing is up about 20-something, 30%. R&D's up a little bit, but no major explosion. Their total increase in operating expenses is 25%. Okay, so their revenue is growing faster than their operating expenses. Their balance sheet, anything crazy on here? I don't see anything crazy. They got about $1.5 billion of cash and $4.2 billion of marketable securities. Total current assets of $8 billion versus $2 billion of current debts. Long-term, they have almost no long-term debt. They got some pretty significant equity investment. They own a lot of other companies. Wow. $4.4 billion of equity and other investments. Interesting. So, I mean, pretty solid balance sheet. I don't see any issues at all with their balance sheet. Yeah, they're not going bankrupt. Let's see. Doing pretty good. Cash flows are up pretty good. Let's see. What are they? Financing it. Yeah, they didn't really. The only financing activities was just some stock issuance for employees, stock option stuff. But they didn't buy back any shares. They didn't take on any additional debt. Nothing crazy like that. All right, so not bad quarter for Shopify, and the guide is pretty solid. And wow. Okay. Finally, we got DoorDash. Then I need to call mommy and daddy after we do comments. Up 7% after hours. Are you a dasher, bro? Do you dash? Oh, this is the color is ugly. I don't like this. All right, second quarter 2025. Total orders increased 20%. Marketplace GOV increased 23%. I guess that's some kind of like volume metric, dollar volume metric. Revenue increased 25%. Net revenue margin was 13%, 13.5%. GAAP net income or loss increased to $285 million. So they swung profitable year over year. Let's see. Did they update this already? They did not update stock analysis already, but we can go see when they became profitable. They became profitable in the third quarter of 2024. And last quarter, they had $193 million of profits. And this quarter, they had $285 million of profits. That's pretty strong profit growth. Yeah, they're doing pretty good. I don't do DoorDash. Who does this? Like, this is why you're broke. You buy this freaking I can't get off my butt and go pick up my own food. I got to spend $20 extra to get a Taco Bell taco delivered to me. You guys are such Amerifats, man. All right, let's go look at the financial. Oh, here's the financial outlook. Q3 2025. Let's see. What's the revenue? They give us the volume, but they don't give us the revenue. Whatever. Lame. All right, let's go look at their balance sheet. They got $4 billion of cash and $1.3 billion of short-term investments. So you add that together, highly liquid, that's $5.3 billion. And then they have $4.4 billion of short-term debts. So no major issues there. Long-term assets. Very light on property, plant, and equipment, only $778 million. They have a pretty significant goodwill balance from acquisitions of $2.3 billion. Long-term debt. Oh, convertible notes went to zero. Did they convert all of their convertible notes to stock, or did they pay it off? I don't know. Let's see. Okay, this is such an ugly color. Ugh. Okay, yeah, I see the stock increased. The shares outstanding, so they might have converted those notes. Let's go look at the financing. Proceeds from issuance of convertible notes. Oh, excuse me. I think I read it freaking bad. See, I hate when they flip the freaking financial statements. They took on debt. I apologize. They took on $2.7 billion of debt. I hate when they freaking flip the financial statements. Okay, so overall, pretty solid. I mean, Amerifats are just loving to freaking order. They're loving to order their food and get it delivered. So they swung to become very profitable, at least compared to last year, and they seem to be doing pretty good on most metrics. So that's the earnings for McLards, Walt Disney, Uber, Shopify, and DoorDash. What do y'all think? All right, let's dig into the comments, and I got to call my mommy and daddy. Good God, there's so many comments. Oh, we got a new member here. Welcome. I can't say your name. Talk about Nike, how I've been printing money. You vertical lining. I got 2 more streams to go. Ryu, sup, brokies. It amazes me you reject McDonald's and also the procedure to remove. Oh my God, dude. I don't even know what to say to that. You going to a Gaza protest? No, I don't go to protests. What's up, Why So Blue Tube? I'm only doing member comments, so blow me. You want me to answer your comments? Become a member. Hash browns are expensive at McDonald's, and the disgusting Amerifats are gladly paying. I stopped McDonald's completely. I go to Chick-fil-A or I go to Chipotle. That's it. Daddy's here to taste those delicious. Yeah, most of the stocks we looked at did pretty well. We don't talk about LaFufu on earnings days. Why So Bluetooth for $1.99. Tindies, my indies. Thank you, good sir. Thank you, good sir. Okay, our new member spamming a bunch of rhymes that are for Lafufu. Star India is their streamings. It's India. We're expanding into India. McSharts. Need some Chipotle for the McSharts. Hulu is hanging on by it's always Hulu is. I remember Hulu being so freaking bad. I was like, who watches this? I'd rather pay for Netflix or just watch YouTube. Disney's hanging by its Star Wars. I don't even watch the new Star Wars. Hulu grew that much because it's been absorbed by Disney, and it will just be part of Disney Plus starting in 2026. The Predator animated movie. Yeah, I don't watch any freaking Disney, to be perfectly honest. Disney earnings would be better if they were more inclusive. Good point. Your parents aren't paying you $5 a month. They paid a lot of money to get me to where I am today. Trust me. All right, Gil's in the house. What's up, man? Lyft is a free cash flow. Yeah, but Lyft is a very tiny competitor versus Uber. The free cash flows for Lyft are dirt cheap compared to, yeah, but Uber is growing. I haven't looked at Lyft, but I think Uber's been clapping Lyft. Bra, you'll be surprised that broke people usually do deliveries. Oh, I know. People. That's why people are broke, because I gotta get my food delivered. What? If you're broke, eat at home. Make yourself some pasta. Okay, pasta is I can make pasta with sausage for like $5, and it feeds me for 2 meals. $2.50 a meal, and it's delicious. Whole wheat pasta, pasta sauce, and sausage on clearance. Big, juicy sausage. $5. Oh, I need to order McDonald's. $50,000 a delivery. Brah, Lyft is so much more interesting than Uber at this juncture, and they just reported today as well. Lame. And of course, deliveries went up with the Pay Now service. Stupid Matrix trap. If I was president, ban. Would you ban credit cards? Uber sucks. Lyft is taking market share, and the service is... Hold on a minute. Let's see. Ride sharing market share. Uber versus Lyft. Yes, I burped.
Oh, so unprofessional.
Okay, well, according to AI, my hot, sweaty guy. Oh, hold on a minute. Hold on a minute. Oh, that's back in 2017. I can't really get any new information. Well, at least right now, being rushed, but I just remember Uber was dominating in market share. Like, absolutely clapping. Yeah, I can't find any good statistics right now, but I'm pretty sure Uber's been dominating in market share. Rio, what's up, man? You can earn Oh, wow. Now I'm bullish. Gil's running for president. You can go to any big city and all the bikes and scooters are linked to Lyft. Lyft is the better play from an investing. I mean, maybe. Uber is technically cheaper than Lyft in my area. That's been my observation. And since I take an online class just for fun, I get those student discounts for Uber One. I don't use Uber Eats unless I have some nice discounts. I never use it. Vertical lines into infinity. I have an Uber Eats coupon right now for $20. Yeah, somebody gave me a coupon one time. That's the only time I use delivery. All right. We're going to have to close this up pretty soon, guys, but we got 2 more live streams. Maybe 3 if I want to clap back at Stockmo. We'll see. DoorDash is the cost of food plus taxes plus a $5 tip. I don't get why people do it. It's pure laziness. Better to just go buy steaks and beef, cook it yourself. Cost me like $10. Or go to Chipotle. It's $10 for a big fat sandwich. All right. Maybe if you pay me $50. Lyft ain't taking anything. All right. Well, thank you guys for tuning in. Welcome to our new member, Mr. Baggins. but change the B to an F. No, I'm just kidding. And then thank you for the generous super chat. Let me go call mommy and daddy, and then we're going to go on to our next 2 live videos. See you guys soon.